Welcome back. I'm Pratap here. Today is the 21st March 2025. In this video, I'm going to evaluate the performance of the high liquidity zones generated in the previous end of the day report. Before that, all of you please note we are providing complete free training on supply demand zone price action. You might be knowing the cost of the training is highly expensive, but we are providing complete free training. And all the training lessons are available at our NeoStock YouTube channel. At our channel homepage, click on the tab Posts. Some of you might be seeing the tab Community. Click on the Community tab. You get access to this post. This post is having a YouTube playlist link that will take you to all the training lessons. You just click on the link. Now we are into supply demand zone price action course. And I kept all the training lessons in this playlist. You just scroll down to the bottom of the page. Here, starting from lesson 1.1, all the training lessons are placed in an order. So please go through all these lessons one by one according to the training instructions I mentioned at our Telegram channel. I provided the link to our Telegram channel in this video description. So please join at our Telegram channel. At the top of the window in the Telegram channel, you can find pinned messages. Click on the pinned messages. So one of the messages in the pinned messages, you will find that all the training instructions. So learn this course according to those training instructions. Definitely you will become a very good independent trader in the coming months. Now let's get into our HLQ zone analysis. Performance evaluation. So yesterday we identified 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Even Nifty is also there, 12. High liquidity zones from daily and 75 minutes time frame. And the Nifty, yesterday's report, Nifty reported twice. One is daily high liquidity supply zone and another one is 75 minutes high liquidity demand zones. And also Nifty daily time frame moving between high liquidity daily demand zone. This rally base rally is a Nifty high liquidity daily demand zone. And also this drop, two base candles drop is a high liquidity daily supply zone. At present prices are moving in between high liquidity zones. And the stock is near to the daily high liquidity supply zone and also near to the 75 minutes high liquidity demand zone. But we got the trade from daily high liquidity supply zone. How we fine-tune this daily high liquidity supply zone? Based on next time frame 75 minutes. Here we have a 75 minute zone. We have a drop. We have 1, 2, 3, 4 base candles and a drop candle. This is how our software identified. Drop, base, drop. Even our software also mentioned the same zone. Nifty and Bank Nifty supply demand zone chain report. If you look into the Nifty supply demand zone chain report, and that report 75 minutes time frame reported this as a drop, 4 base candles and a drop. And within this 75 minutes, again fine-tuned with 15 minutes time frame. Excuse me. Inside the see here, drop, base, drop. So this is a 15 minutes high liquidity supply zone identified by our software. Supply demand zone chain. In the premium videos, these zones you can find. Drop, base, drop is the 15 minutes high liquidity supply zone. And within this 15 minutes high liquidity supply zone, see this is there inside 75 minutes supply zone. 75 minutes is there inside daily high liquidity supply zone. So now inside this 15 minutes high liquidity supply zone, we have 5 minutes time frame zone. This is a fine-tuned 5 minute zone, not the high liquidity zone, but it is a fine-tuned. How a software identified? as a drop, 1, 2, 3, 4, 5 base candles and a drop candle, follow through candle. The type 2 proximal we have drawn. This 5-minute zone. Even our software also identified this 5-minute zone. This drop, 5 base candles and drop. But it is a normal zone. As of now, it is not a high liquidity. It is a normal zone, but fine-tuned. It is having importance because it is a fine-tuned 5-minute zone. If you look into 5-minute zone, its zone distal line is outside the 15 minutes. Sometimes zone will be overlapped at the distal line. Remember, this is not the lesson 22 concept. Lesson 22, before the zone should create, but not within the zone. This everything is part of this zone, 15-minute zone. Few candles before and few candles within the zone. But leg out is within the zone. So this is a normal zone confluence concept, but 5-minute zone is having a zone confluence at the distal line of the 15 minutes high liquidity supply zone. That is the only difference you have to observe. So this is our entry. And before that, and few more points I have to tell you. And here you have one more 5 minutes high liquidity zone, rally base drop. This is a high liquidity supply zone. You can use this as an aggressive trade setup inside daily high liquidity supply zone. As I told you, HLQ zones, lower time frame HLQ zones can be used as an aggressive trade setup. Because it is a high liquidity zone, they have higher chances. These zones may give you some success. And here also we have a zone, but we didn't draw because this is a normal 5-minute zone. Normal 5-minute zone, so without price action clues, you cannot plan aggressive trades. But this is a high liquidity zone, we have an advantage. How do we know this is a high liquidity zone? The Nifty 5-minute supply demand zone chain that described this as a 5-minute high liquidity supply zone. And also there is one more 5-minute high liquidity supply zone. Drop base drop. This is also 5 minutes high liquidity supply zone. See how beautifully institutions created the order flows. You understand? See, first they created a high liquidity zone here. From this high liquidity zone, it picked up the orders. This entire daily zone is created. Go to the daily time frame. Now you get better clarity. See, this is the daily zone. Drop, 2 base candles and drop. So in this drop candle, institutions created a 5 minutes high liquidity supply zone. And this 5 minutes high liquidity supply zone is the origin for this entire daily zone, daily high liquidity zone. This is a daily high liquidity supply zone. And it picked up the orders from this 5 minutes high liquidity supply zone. This 5-minute zone as an origin to this entire daily supply zone. Your lesson 22 concept. So this is having a very strong institutional order flow. So we have multiple. This is one trade up plan, this is second trade plan, and this is the third trade plan. And today we got the trade from the first one, but it is not an easy trade. The reason is the zone is pierced, but it is within the stop buffer. And then prices came down and finally reached this 15 minutes target zone. Here we have a 15-minute zone. Rally, base, rally. And I also suggested you in the Telegram channel, once it reached 15-minute zone, I told you maybe those who are looking for more profits, you can look for 1-minute zone also. I calculated up to 15-minute zone profit. Maybe some of you got a little extra profit if you would have gone for 1-minute trailing stop. See here we have a drop candle, base candle, drop candle. This is the one. This supply zone is violated. Now you will exit the trade and book your profit here. You may got a little extra profit. Those who use a trailing stop loss would have got a little extra profit. But those who booked the profit, you would have booked the profit at this 15 minutes zone. Here you would have booked the profit. So I calculated the profit up to the 15 minute zone. This is the 15 minute zone. Rally base rally. And one more important point actually, from a long time I wanted to tell you. Everybody please concentrate. See, what is the cost of one, let us assume, of course, you will be buying in F&O, but intraday you might be taking a cash segment. In cash segment intraday, even you can buy one Nifty, right? What is the cost of one Nifty? One share of Nifty, that way I can say. It is around 23,000 rupees, right? 23,380 rupees, something around here. For buying one Nifty during the intraday cash segment, if you want to go for a short or if you want to go for a long, you have to spend around 23,300 rupees. Is it compared to 500 rupees or 1000 rupees stocks? 23,000 is how many times more? So for buying one share, you are spending huge money here, right? See, when prices are going up, increasing, you have different ranges of prices like 100 rupees or less than 100 rupees, less than 1000 rupees, or less than 5,000 or 10,000, less than 20,000. Few shares you are having a cost around even 80,000, 90,000, 1 lakh is also there. I think MRF cost is a highly expensive share, right? So when you are using such kind of high value, say for example Nifty is a high value instrument. If you want to buy, you need to invest more money. And especially when you are applying stop buffers. This is the topic related to stop buffers. How to use stop buffers when you are using high value. Do you remember I told you should round the value to the nearest paisa in our course. Generally, those rules are applicable for less than 5,000 rupees related stocks and all. But what about more than 10,000 or 15,000 or 20,000? Stop buffer, you have to round the value to nearest rupees, like 5 rupees or 10 rupees or 20 rupees, 15 rupees. That way you have to round the value. See, Nifty is having a stop buffer 40 or 50 is there. Around 7.43% ATR value. Generally, when it is 7.21, what you do? You will round the value to 7 rupees 25 paisa, right? But when you are using the 20,000, 30,000 or 40,000 worth related, suppose if it is 7.30 or 7 point anything or 8 point anything or even 6 point anything, you have to round the value to the nearest, not the paisa, nearest rupees values. Say for example 10 rupees, multiples of 5, that is the way you can understand. 7.5 means you have to round stop buffer to 10. You have to add 10 as a stop buffer. Suppose if it is 3.6 is our ATR value for 20,000 rupees worth related stock. Round it to 5. Make it 5. The reason is for 20,000, these one unit value or 2 rupees equivalent unit values, they are negligible. Actually, why we are rounding the value? To give some more extra weightage to stop buffer. Giving paisa for 20,000 and giving the same paisa for 10 rupees stock, can you imagine the difference? 10 rupees, 1 paisa if you are adding, it's a huge, it's almost like we are adding 0.1%. Adding 1 paisa is equivalent to for 10 rupees stock. But if you are adding 1 paisa or even 10 paisa or even 1 rupee for 20,000 rupees value, that is almost negligible. That is 0.001% equivalent. So that's why the significance should be, some value addition should be there. That's why stop buffers. Because these Nifty and all generally, while they are moving up and down, all of a sudden you see like 2 rupees or 3 rupees difference, the values will be jumping up or going down. But if you are using 10 rupee stock, you will be seeing 10 rupee 1 paisa, 10 rupee 2 paisa, 10 rupee 3 paisa. That way price movement will be there. But Nifty related stocks, it's like from, say for example, 20,000 rupees current value, let us assume. All of a sudden price will jump to 20,003 rupees, 20,008 rupees, 20,015. That way prices will be moving. It will not move like 20,000 1 paisa, 20,000 2 paisa. That kind of movement won't be there. So that's why stop buffers values you should consider in an intelligent way. Whatever the stop buffers we are giving, they are the minimal value. And the round off should be done in a careful way. Same thing, Nifty 7 rupees, ATR value is showing some 7 point, some 3 or 4 something it is showing. You have to round it to 10. 10 points you have to add to your stop buffer. That is the way you have to take the decision. Why I am telling, if you are doing such kind of stop buffers for Nifty today, you would have got a successful trade. If you are adding 7 rupee, maybe with a difference of 1 point, Nifty, just with a difference of 1 point, your trade would have been stopped out today in Nifty. If we take 7 point, some 7.4 or 7.5 is there. If you add just 1 rupee difference, the price went up and then came down. Just because of that 1 rupee difference, you would have exited your trade. Your trade would have been stopped out. Maybe this lesson I would have told you a long back, but anyway, today only I realized it. Maybe I thought this is a good example to make you people understand how the rounded values would have helped you. You are within the trade today. If you would not have rounded properly, probably you would have kept like this. Your stop buffer could be like this. See, just above it went, very small, just one point. With that 1 point, you would have exited your trade and immediately see how sharply Nifty came down. Just because of that 1 rupee difference. Now you rounded to 10 rupees. Instead of 7 rupees, you rounded to 10 rupees. Still you have another 2 points gap is there. See what is after adding the 10 points stop buffer value, your stop value is 23, 403, 70 paisa. See the high of the candle, 23, 407 paisa, 70 paisa. If you would not have added that buffer, it could have been 23, 401, maybe some 30 or 40 paisa. With that 1 point difference, your trade would have been stopped out. Now because you rounded that Nifty stop buffer value to the nearest digits equivalent to like 5 rupees. It's multiples of 5 rupees. See, if it is a 50,000 rupees stock, there are, see, Nifty next, Nifty next 50, yesterday we got the trade. What is the value Nifty next 50? 62,000 rupees. The indices value is 62,000. So one stock is equivalent to 62,000 rupees. When you have such kind of values above 50,000, you round it to 10 rupees every time. Suppose your stop buffer is 12.7. Say for example, Nifty Junior, that is Nifty next 50. Let us assume 3% ATR value is 11.2, say for example. Then how to round that? Not 15 rupees. You have to round it to 20 rupees. Why? Because it is a very big high value. 5 rupees is almost negligible. So that way you have to take a clever decision. You can assume like 0.01% level, you round off the value, you will get clarity. Say for example, Let me show you the calculations. If a stock value is 50,000, .1%. Sorry, 50,000 into 0.2%. 0.2 divided by 100. It's not 0.2, 0.002. Yeah. 50,000 into 0.002 divided by, I think I'm making some mistake. 50,000 into 0.02. Yeah, 0.02 divided by 100. So you are getting 10 rupees. That means you round off with 10 rupees. It should be like the value should be either 10 rupees stop buffer or 20 rupees stop buffer or 30 rupees stop buffer. It should not be like 15 rupees or 16 rupees or 17 rupees. Suppose above 5,000 stocks, you can round off, or maybe about 10,000 rupees stocks, you can round off to like 5 rupees. Like it should be, suppose if it is the 3 is your stop buffer value, make it 5. Suppose if it is 7 is your stop buffer, make it round off to 10. So this is the way you have to, because otherwise, because the values are high, like when points are moving with a difference of 2 points or 3 points frequently. Of course, sometimes you see 1 point, 2 points differences. Sometimes you see even 0.5, it's like 10 paisa, 20 paisa also movement you see when market volatility is very low. But volatility is high, all of a sudden 3 rupees it will go up, next 3 rupees it will go down, or 4 rupees it will go up, again 2 rupees it will go down. Within the rupees their prices will be moving. Such kind of situations you have to use 5 rupees is our buffer value. Round off value. So please remember these points. They are very, very important. Today's Nifty is a very good example to understand. Those who rounded the Nifty with 5 rupees difference, you would have been within the trade. Today, who rounded Nifty with only paisas? Paisa value, maybe it might have shown you some 7 rupees, say 12 paisa. You rounded it to 7 rupees 15 paisa. Your trade would have been stopped out today, just 1 rupee difference. After that 1 rupee, price sharply came down and reached the 15 minutes target. So this is a very, very important topic. How you have to take a decision depending on the cost of that particular script. Whichever the script you are trading, see the cost. If it is within less than 1000 rupees, you just round the values to its nearest paisa values. If it is between about 1000 or less than 10,000, you round off the values to the nearest 1 rupee denomination. Say for example, if the ATR value is 7.6, the cost is above 1000 rupees. 7.6 you round off to 8 rupees. 7.62 is there. Don't make it 7.65. Round off that value to 8 rupees. So if it is above 10,000 rupees, that value, the round off value, should be within 5 rupees ranges. If it is 11 rupees, you make it 15 rupees. You round off to 15. If it is 7 rupees, round off the value to 10 rupees. Suppose if it is more than 50,000 rupees, the cost, round off to based on 10 rupees level. Say for example, if it is 11 rupees, make it 20 rupees. If it is 19 rupees, make it 20 rupees. If it is 26 rupees, make it 30 rupees. It is 23 rupees, make it 30 rupees. So that means 10 points difference you are rounding the value. See, this is the decision you have to take cleverly. See, all these days you are all beginners. In the training course, all these points, minute level points, if I am started explaining in detail, grasping all these points during your initial course is not easy. First, you should adapt to understanding stop buffers with some fixed values. That is what you land. You just round off to the nearest value, paisa. Now you are doing the trading. Now you are gaining experience. Now you know price differences, how prices will be 1,000 rupees price value and 10 rupees or 100 rupees price value. There is a difference, price movement. The buffer values will be changing. The 10 rupees buffer value and 1,000 rupees buffer value, there is a huge difference you will be seeing. So that's why the round off techniques also should be more accurate when you are using. And why I am telling, see, 20,000 rupees, when you add 3 points extra, the risk won't be changing. The risk will be just 0.001%. That's it. Extra risk will be added. Nothing more. But if you are adding same 10 rupees to 100 rupees stock, see how risk will be changing. 100 value will become 110. So 10% risk you are increasing just by adding 10 points to a 100 rupees stock. The same 10 points, if you are adding to 10,000 rupees, it is like how much? 0.01% only. Right? How much percent? Say 10,000 rupees you are adding 10 for 100, how much? 100 into 10 divided by 10,000. So that is equivalent to 0.1%. So adding 0.1% extra risk, that won't impact your RR calculations, risk reward calculations, right? Just 0.1%. So this is the reason behind why we should increase the buffer round of values when the price value is increasing. Hope you might have understood now. Let me repeat again. 10 rupees extra value if you add to your stop buffer by rounding. Say for example, your stock is 1 rupee ATR value, 1 rupee for 10,000. Let us assume. It won't be that much small. Let us time being assume. So instead of 1, you are making it 10. How much impact it is on your stock? 0.1%. Additional risk will be increased. Suppose same 10 rupees stock, you add it to 100 rupees. I mean same 10 rupees additional buffer, you add it to 100 rupees. Your stock value is 101. You round it to 110. Can you imagine? Now it is almost 10% or 10% extra risk will be added. What is our maximum accepted risk? 2%. For 2%, instead of making it 2%, you made it now 12% by adding extra 10% buffer. You got the point, right? So that's why when the values, script value is less, your stop buffer round off value should be small values. When your script value is very high value, the round off value for your stop buffer should be even with the 5 rupees gap or 10 rupees gap you can apply. Because overall impact on your risk is negligible. And what is the advantage we get? When volatility in the market is a little high, because of the small volatility, price just cross your stop buffer and again go back and reach your target. Such kind of trades you will be getting, you will be missing. Instead of getting profit, you get losses. Just because of these round of values, properly you are adjusting, your trades might be saved. If your trade is not saved, if trade hit the stop loss, still the impact will be only 0.1%. That is okay for us. 0.1 is negligible. But instead of booking the loss, you book the profit. See the impact. It is a huge impact. Nifty today maybe you would have got, in case with that, just because of that 1 rupee gap, if you would have stopped, if you would have exited with the stop loss, maybe you might have got around maybe 1% loss you would have got. Actually, it is around, I think, around 0.8 or 0.9%. 0.9. So, close to 1%. Instead of getting 1% loss, today you got Nifty 2.7% profit you got, which is 5,329 rupees profit you got, which is 2.7% ROI as per your capital. It is almost close to 2 lakhs rupees, around 1,98,000 is there, the margin cost. So that's why ROI is reduced. But you got 5,329 rupees profit today. Instead of getting this 5,000 rupees profit, maybe today you would have got 1,200 rupees or maybe 1,300 rupees loss. You might have booked the loss just because of the stop buffer round of values you are not taking care properly. Simple technique. Today saved our trade. This is a good lesson. If anybody hit, you booked your loss, nothing to worry. Today you learned an important lesson. You never forget this lesson. Maybe you might be feeling, maybe I would have known this lesson some more time before. Today I would have got the profit. That is the way you might be, you might feel. But today is the right example we got. And today is the right time with this example to explain this concept properly. Why I spend so much time on this concept? Because in future, this concept might be saving a lot of your trades. Now, some of the trade just hit the stop buffer and again they reverse. Previously also we have seen some 2 or 3 stocks, we booked the loss just because few paisa it moved up and again came down. But why I selected Nifty to explain this concept? Because Nifty, the price is over 20,000 rupees. Now it is easy for me to explain with the percentages. Adding 10 rupees additional stop buffer by rounding the value, my overall risk is increasing 0.1% only. That example I got today to explain, so that it won't impact our profitable margin or it won't impact our risk calculations also and RR calculations also. And that is one thing. And another thing is, till this 15 minutes target zone, you have only 2.5% RR. You have only 2% RR if you take your entry at the type 2 proximal. So that's why, did you notice I slightly moved up? See, earlier I should have drawn like this. If I draw this, what is the RR I am getting? 1:2.38. That means 1:4 RR I am getting. To get 1:3 RR, what I did? Yesterday also we discussed this technique. But again it is a revision for you. I just moved this value a little above until I get 1:3 RR. See, the moment I moved a little inside my entry to define my entry, see, I got 1:3 RR I got. And today prices reached. Not only reached, even our zone is pierced also. Your fine-tuned 5-minute zone is pierced and again came back. And reached the 15 minutes target. So this is one important lesson for you. That's why Nifty I selected first, so that I can teach this concept. You all will understand. If you have any questions, still if you have any confusion or any questions, please put them in the comment section. I am thinking that maybe I gave you enough explanation. Even then, still if any one of you are having some confusion or missing clarity, please put your questions in the comment section. I'll try to provide the answers. Okay, this is one stock we got, and another one is very important. Yesterday, if you would have listened yesterday's HLQ zone analysis video, today you would have got a profit in another stock. Which stock? JSL. Jindal Stainless Steel. JSL, yesterday I explained how I fine-tuned these zones. Let me go to the 5 minutes. Those who did not listen yesterday's video, please listen yesterday's JSL and then come back to this video. Because now I directly went to the fine-tuned 5-minute zones. What I shown you yesterday, the same thing. See, this is we have two fine-tuned zones. One is the lower time frame horizon. This is the first fine-tuned zone, already a tested zone. It is a tested zone. So we can't plan a trade yesterday. And again another, in case if this is violated, the next one, this is also a tested zone. That's why this is also we didn't plan our trade. Both the zones we didn't plan yesterday. And third one we planned our trade. Why third one we planned? Because this is the horizon, 5 minutes horizon. Inside 15 minutes horizon. And in this horizon, we want to plan our trade. This is what we discussed yesterday. But yesterday what happened? Price entered into this first zone and again moved up. See here. This is what happened yesterday. Price reached and then moved up. And while moving up, institutions created a drop base rally. LOTL zone is created. That means new order flows will be added into this zone. So that's why what is that I suggested you? Next time again if our software lists this stock and next time we can plan a trade in this zone. Why? It could be a high liquidity zone. It could be. Because LOTL may add new order flows. Due to that liquidity will improve. And also already tested multiple times. So, and second time it is tested, LOTL zone is created, at least a confirmation. Otherwise, see, suppose if a new LOTL zone is not created, maybe today we would not have taken a trade here because price reached almost close to the digital line. See, yesterday, price closed almost, it is not violated. Just a few paisa before the digital line started moving up. While moving, a zone is created. Drop base rally is created. New order flows will be added here. That's why we want to plan a trade again in the same zone. Why not before? Because this is the horizon. Always in the 5 minutes time frame, we focus on the horizon. Several times I explained this point. Horizon is the main area. Already some order flow will be there and new order flows are also added. Strong order flow will be there. If you are planning more, even before that, still your stop buffer is, your digital line is this only, even if you keep. But your risk will be increasing. So that's why always the main horizon. This is the main horizon we define. That is the area only you have to plan the trade. So yesterday I clearly told next time when prices are entering, if our software lists this stock, we can plan a trade. What happened? Our software listed this stock again next. For today's trading also, it is again listed yesterday, end of the day report. So definitely we can. See, yesterday we didn't plan the trade, but today we are planning our trade. See today, prices entered into the zone, but here we have a 15-minute zone. This trade is also a little tricky. Why? Concentrate my explanation. See here we have a rally, drop candle, two base candles and a drop candle. A medium size legging, two base candles and a large candle. This is the 15-minute zone. And this 15-minute zone is our target. But where is our entry? In this 5-minute zone. But 5-minute zone at this proximal, type 2 proximal, if I am planning my trade, I am not getting 1:3 RR. So let me keep the actual, what could be the okay. This is type 2 entry. What is the RR you are getting? 1:2.48. Similar to Nifty, what you have discussed in Nifty, same thing also happened here. You are not getting the RR. To get the RR, what I am doing? Taking an entry a little inside until I get 1:3 RR. See, now I adjusted up to this area. Now I am getting 1:3 RR. Till this 15 minutes target zone. See what happened? Prices entered into the zone at 11:40 candle. It just touched our entry exactly. If you missed again, this candle is very clearly entered in the zone and closed below our entry point. Definitely in this candle you would have got trade, either this candle or this candle. So you would have got a trade clearly. The moment you get the trade, your profit is at this 15 minutes target zone, and price reached this 15 minutes target zone. When at 12:20, 5 minutes candle. If you go to 1 minute, you get better clarity. See here, at 12:24, it reached the target and then sharply came down. After that, this entire zone is violated. Second zone anyway we didn't plan the trade because this second zone is already tested. The one below. It is already tested here. Because it is a tested zone, yesterday we didn't plan trades in both these. But yesterday we missed the trade because we didn't plan. But today we planned because we assumed this is the high liquidity area. Maybe new order flows are added. Definitely next time this zone will give a success. That is what happened today. After the trade, this zone is violated and this 5 minutes horizon is also violated. That means definitely we would have taken a trade because this is the horizon. But unfortunately, zone is violated. So this is the area your trade would have been stopped out. Let me go to 5 minutes, you get better clarity. This is the 5 minutes horizon. This 75 minute zone picked up the orders. And then entire move started from here. Next time when prices reach here, this horizon should give good profits to us actually. Lesson 22 concept. Lower time frame zone as an horizon to higher time frame. Many zones, lower time frame zone horizons gave good profits to us. Even yesterday also, couple of trades we got from the horizon only. But today it is stopped out. There are times it will stop out. Maybe there could be a reason why it is stopped out. Earlier, when prices entered into the horizon, they almost came close to the distal line. Maybe that is the reason why. There may not be a strong order flow here and the entire zone is violated. That could be one reason. Or second reason, the existing order flows institutions might have cancelled. Maybe due to their other trade plans point of view, they might have cancelled and diverted the funds to some other zones or some other stocks. Maybe that could be the reason. There could be several reasons. But these two are two possible reasons. One is a price closure close to the distal line of this 5 minute zone. That way this zone may not be having order flow, much strong order, so easily violated. That could be one reason. Another reason, maybe institutions added a new orders here, maybe strong order flow is there, but today they withdrawn the funds because of some other plans. That could be some other reason. But whatever it is, a trade is violated. Because until it is violated, we can't assume what could be the reasons for this failure, right? So it is a stopped out. So we have a successful trade and then we have a stopped out trade. So Jindal stainless steel, the successful trade gave 4,456 rupees profit, which is 3.7% ROI. And stopped out trade has given 1,589 rupees. 1,589 rupees loss it has given, which is 1.3% negative ROI, minus 1.3% ROI, negative ROI. That indicates the loss. So these are the two trades from JSL. So those who listened yesterday's my HLQ analysis video, today definitely you should not miss this trade. See how excellent trade it gave. Only thing is you should fine tune the entry to meet 1:3 RR criteria. That is the only extra work you have to do here today. Because 15 minutes target zone is close to the entry zone. So without 1:3 RR, you can't take the trade. Either you have to reject the trade or you have to adjust or fine tune the entry. I gave a name, fine tuning the entry. You should fine tune the entry and then you should plan the trade by achieving 1:3 RR. Okay, this is about JSL. There is one more thing, we got the trade AU Bank. AU Bank is a 75, daily high liquidity supply zone. I think previously once we already explained this, how I fine tuned. This is a drop base, a drop with hidden body. This one is fine tuned with 75 minutes. Drop base, drop, 2 base candles and a drop. This is the medium size candle. And this one is again fine tuned with 15 minutes time frame. We have two 15 minutes order flows. Drop, 3 base candles. This one medium size is also part of the base and drop candle. Maybe you could have fine tuned up to here because this is the origin. This candle is the origin. Even though it is a medium size candle, the origin is started from here. You can also draw the zone like this. This is also okay. But anyway, this is not the fine-tuned 5-minute zone. I have drawn the maximum so that if any, sometimes there could be multiple order flows will be there. I don't want to miss them. So that's why I have drawn the full zone. But strictly speaking, from where origin is started, till there you can draw the zone to minimize the risk. But where you need to minimize the risk in the entry time frame. Our entry time frame is 5-minute zones. So that is the reason why 15 minutes I kept even the medium size candle is also part of the base, even though we know that this is the origin started. What is the origin? For imbalance. We are using the word origin several places. Lower time frame origin, that concept is different. This origin is different. This origin indicates the imbalance, from where the imbalance started, from this candle. But this is not a leg out candle. This is only medium size candle. Even though it is medium size candle, the next one leg out is there. Otherwise, you would not have drawn this zone. But why we are fine tuning up to the base candles is, this is the actual origin imbalance started. Maybe the 5 minutes or 15 minutes candle. This is the 15 minutes time frame. 15 minutes time frame candle time is completed. If the time is not completed, it would have fall would have been continued. That's why in the next candle we have seen this. Okay, now go to the 5 minutes time frame and also one more 15-minute zone we have drawn here also. Two 15-minute zones we have drawn. Next 5 minutes time frame. All these are all I already previously explained. But why I am explaining again today, that there is a reason. The entry. See, this is the leg out. This is the medium size candle. How you will draw the zone? Like this. But if you draw the zone like this, risk will be beyond 2%. The risk is beyond 2%. So that is the reason why what I did for the trade planning point of view, because this is the place imbalance is started. That's why I have drawn. Of course, this is not the leg out. Leg out is, this is the candle. But the actual imbalance started from this here and continued in the next candle. And this is the area narrow range is there. Probably this is the area strong institutional order flow will be there. And leg out is also, the actual leg out also, when it is started a huge order flow again added in this area, then they push the market down from here. So I thought probably this is the area we can plan our trade. So that risk will be within the accepted limit. And also the other one, this is a failed ERC as a drop candle, 2 base candles and a drop candle. These are the 2 fine-tuned zones. This I already explained earlier. But the only change I made today, that's why I am explaining today. This is the area, instead of drawing the zone because it is beyond 2% risk, this is how I planned the trade plan point of view, trade planning. See, today prices entered into the zone, slightly pierced, slightly. See, your stop buffer is here, up to here, slightly, and then prices came down, and reached 1:3 RR. It achieved 1:3 RR. Exactly after achieving 1:3 RR, again prices were started moving up, and finally this zone is violated. Okay, those who booked the profit at 1:3 RR level, you would have got the maximum profit. Or those who did not use 1:3, they did not book, and expecting prices further will go down up to 15 minutes target. Where you have the 15 minutes target? Maybe somewhere here. Drop base rally with hidden body rally. Or maybe you can also assume, but not a great leg out, you can also draw up to rally base rally. That way also, and follow through candle. That way also you can draw a zone, 15 minute zone, like this. But failed to reach this 15 minutes target. But achieved 1:3. Okay, those who did not book the profit and 1:3 and expecting prices reach, what they will be doing? Because it already achieved 1:3, immediately you start implementing your trailing stop. So go to 1 minute. After reaching 1:3, immediately your trailing stop will be enabled. If any near to the zone, 1:3, 5 minutes zone is there, you will use 5 minutes trailing, but there is no nearest 5 minute zone here. So that's why you will go to 1 minute trailing stop. Is there any 1 minute zone available here? Yes. Here you have a drop base drop. This supply zone, 1 minute supply zone. Sorry. Okay, when it is violated here. So here you would have booked your profit. If you exited here, probably some of your profit would have been reduced. But still you get profit, right? What is the rule? Once it is reached 1:3 RR, immediately your trailing stop will be enabled. The nearest 1 minute zone or any close to 5 minute zone, you will use 5 minute zone, because 5 minutes is much powerful than 1 minute zone. Sometimes 5 minutes can hold the prices. But if there is no nearest 5 minute zone, immediately you go to the nearest 1 minute here. You have a drop base drop. The moment it is violated, here you would have booked your profit. Let me draw a horizontal line so that you get clarity. Maybe just above a small buffer, very small buffer, you will add. You won't calculate any stop buffers here because this is trailing. Just safety point of view, a small buffer you will add. Still, if you want to add some more, you can add like this. Sometimes what happens within this, it will violate within the buffer, again turn and it will come down. So that's why you don't want to move. If you add more buffer, your profit margin will reduce, right? So that's why some kind of trade-off is required here. So this is, up to here you would have got maximum profit and some of your profit would have been reduced. How much in case if you did not book the profit at 1:3 and trailing stop hit, and if you would have exited your trade, this is your entry price, how much profit you would have got? Let me calculate. Minus the blue color line, let us assume you exited your trade and booked the profit. You would have got 2.35 profit you would have got. I think lot size is 1000 rupees. So into 1000 AU Bank lot size, you would have got 2350 rupees profit. But those who booked the profit at 1:5 RR, AU Bank, you would have got 3750. See, still you got profit, but maybe another 1200 rupees profit margin you might have missed here. But something is better than nothing, right? So this is the reason why after prices achieved 1:3 RR, those who don't book the profit, immediately you should enable your trailing stop. Because many times what happens, prices after reaching 1:3, it may get a lot of selling pressure. Whatever the positions they might have already taken, they will clear all those square of all their positions. Automatically pressure will come and again market will be started moving up here from that. That is what happened here. Where is it? Let me go to 5 minutes. Sorry. Trading view is struck up all of a sudden. No internet. Okay, my internet is gone. Some problem with. So what I do, now I can't open the stocks. Anyway, the one we want to discuss, we completed. These are all the trades we got. And remaining, we did not get the trades. And also, see, after that, this is violated. And this is violated, and you see, again, you got a trade here. But here, you can't take a trade. The reason is almost at 240 or something, closing hour. In case if anybody would have taken, this is also pierced, but this is within the stop buffer. Just touched that stop buffer value and immediately sharply came down. Maybe, but this is not good enough to book a good profit here. Maybe somewhere here you booked before closing the market because this is last 1 hour trading. In case if you took the trade at after 2:30, maybe before closing the market you have to. And moreover, after 2:30 you can't plan your trades in the cash segment. Only F&O, in F&O only you can take. Maybe somewhere here if you book your profit, you would not have been getting any profit or loss. I do one thing. Give me a minute. Let me open my mobile data. I will open and I will access, but it is very slow. Mobile data is. Mobile data. Okay, mobile data is connected. How good is it? It's very slow. Okay, good. See, after reaching 1:3 RR, and after that this zone is violated, and then next fine-tuned zone it reached. See, this is, excuse me, this is the one holded the prices. Maybe demand is also strong. It's consumed all the orders, and just it is violated the zone, pierced, and after that the demand is also gone, maybe, and now supply pushed the prices, because anyway this is the supply zone. Some supply will be there above the zone. If no demand, obviously what happens? Supply will push. But this push is not good enough to book a good profit, because where is our 15 minutes target zone? Your 15 minutes target zone will be somewhere here. Maybe drop, base, rally. And market is over. So somewhere here you would have booked, in case if anybody taken, booked our profit, and whatever the profit you got, that is negligible. Maybe that profit might be enough for whatever the taxes you paid, the money you would have collected back with this profit. That means finally no profit, no loss. So that's why I'm not registering anyway. This is the last 1 hour. Focusing on these trades is meaningless. So these are the successful trades today, and remaining we did not get any trades. And Nifty, now loading also it will take quickly. Let me finish. Let me go to the daily time frame. This is a daily supply zone. Here we have a 5 minutes horizon is there. You can look into the charts. There is a 5 minutes horizon. That is the one we are planning our trade here. Let me go to 5 minutes time frame. Here we have a 5 minutes horizon. This is a drop, 1, 2, 3, 4, 5 base candles and a drop. And this 5 minutes horizon, this 5 minute zone is the origin for this entire daily high liquidity supply zone. And within this area, we can't plan the trade. See, huge risk. The structure, many times see such kind of zones, the order flows will be there at the origin. Okay. And the next one is HR Motors. This is also daily high liquidity supply zone. Here also we have a 75 minute zone. Drop, base, drop. So here at that 15 minutes, at the distal line of the 75 minute zone, we have an origin. See, rally, base, drop. This is the origin. And 5 minutes time frame, I think 5 minute structure is not good. I didn't draw any zone in 5 minutes. Yeah, 5 minutes also the structure is same. Drop, or maybe rally, 3 base candles and drop. Or maybe drop, 4 base candles and drop. Either way you can consider. Same 15 minute zone is also 5 minute zone. So this is the 5 minutes horizon for this 75 minutes high liquidity zone. Here 15 minute zone I have drawn here, not here. Here. Here I have drawn a 15 minute zone. Drop, base, drop. Then why I didn't draw 5 minute zone here? Go to the 5 minutes. You should understand why I did not draw 5 minute zone. It looks like we can draw a zone, right? This is I can draw, this is a rally, 1, 2, 3, 4 base candles drop. Yeah, if you see like this, you will understand because the scaling problem. Due to this huge gap, the scaling adjustment in the software, there will be problems. That's why hide this gap, you will get the clarity. So now look into this candle. What kind of candle it is? It is a large candle, failed ERC candle. Such kind of candles you can't use as a base candles, right? This is not a medium sized candle. This is a large, very large candle. Earlier the gap is enabled. It looks like small, medium sized candles. But actually now you see these are the medium sized candles. But this is a large candle. So that's why I don't have any confidence on this zone. But origin is there. From this origin it picked up the orders and market started moving down and finally moved down. Maybe you can plan a trade, but anyway today prices did not reach into the origin. Only prices entered into this 5-minute zone. But from here it came down. Why from here it came down? Institutions created a rally-based drop. Maybe some of you would have taken a dynamic zone trade here. Maybe, I don't know, I missed in my analysis. This is possible, right? Rally-based drop is created. Now again rally-based drop. Maybe institutions might be creating this zone as a high liquidity zone. This is the 15-minute zone. In the 15-minute zone, institutions created a dynamic zone. Rally-based drop. See, medium-sized candle rally-based drop. From here again LOTL zone is created, rally-based drop, and this is the origin. Is it having minimum 1:3 error? If it is there, we can consider this is a successful trade as per our lesson 21.7 or 8. I explained dynamic zones. Dynamic zones means during live market, fine-tuned zones will be created. They are called dynamic zones. I explained in lesson 21.7 or 21.27, lesson 21.7. If not 21.8, in one of those lessons I would have explained this concept. So where is that short position? Okay. Approximately I am adding some stop buffer. This could be your entry. It has given 1:4 RR, it has given. Okay, 1:3 is a successful trade, right? Up to here. This is a successful trade. Actually, software worked excellent way. Maybe I didn't follow, because too many stocks are there in the list. I didn't concentrate on this stock. But actually a dynamic zone is created today. Because my concentration was only on this 5-minute zone. When you have more stocks, it is impossible to track all. In the live market price actions, see, if few stocks are there, tracking live action, live market newly created zones, tracking is easy. But today it's not so easy. But actually it happened. When it gave you the trade at 1325 candle. Is it a fine-tuned 5-minute zone? Yes. Why? Because this 5-minute zone is there inside the 15-minute zone. See, this is the 15-minute zone. Drop-based drop. And inside this 15-minute zone, we have a 75-minute zone. Where is the 75? This whole thing. Drop-based drop. And this drop-based drop is inside the daily zone. So that's why this 5-minute zone is a fine-tuned zone. But it is a dynamic fine-tune. The reason is this drop-based drop is created today during the live market. After the next second candle, you got the entry. But that entry is also again rally base drop, LOTL zone. That means next time also this zone will work. And moreover, little before this zone, see prices, because here LOTL zone type 2, they are holding the prices. So next time maybe it may give you another trade opportunity because of this rally base drop. Actually, we have to calculate these statistics for performance point of view. How do I calculate? Let me show you. In case if anybody wants to see the calculations part, this could be a good example. I open zero the margin calculator. This is March futures I selected, and the net quantity is 175, and at the time of closing the market, the margin cost is at the time of closing, not at the time of our taking entry. But I do approximate calculations. I will guess approximate values. How I guess approximate value, that also I will explain. But at present 125. So what could be the profit? HR Motors. What is the entry? First of all, before that, I should make sure this is risk is within our accepted. That is less than 2%. That is important. So first, I will not calculate the profit. I will look into the stop buffer. Thus, I added approximate. But generally, what I do, I look into our ATR values. Then I will set the value here. But now we are in the analysis video. So approximately, I kept my stop buffer, but mostly the value will be very close, because my experience, without seeing nearest values, I will be able to predict. Okay, so let us assume the stop level is 5329.35. See, what is that I am calculating first? I am calculating the stop loss ratio. I am calculating the ROI, the negative ROI, how much in case if the trade is stopped out. Because we should not accept the trade beyond 2%, right? So that's why first I want to check that. So what I am doing, the stop value minus entry value, because this is the supply zone. So I got 7.25. This includes stop buffer. So one share for one lot, for every share, we will be getting 7.25. What is the lot size? 175 into 175. We would have got 1,268.75 rupees loss. And this loss should be within 2% level, not beyond 2% level. What is the lot size? 1,66,492. So into 100 divided by this margin value, future. But I don't consider this value as it is, because this is at the time of closing. Where is the closing candle? Closing candle is here. Where I would have taken a trade here. I would have taken my trade here. When price moved up to this here, some more value would have been increased. See, when prices are going down, your margin values will reduce. When prices are increasing, your margin value will increase. When they are going, margin value will reduce. When prices are going down, margin will reduce. When prices are going up, margin will increase. That means when prices are moving up until this entry time frame, entry zone, the margin value will slightly improve. But this is almost close to my entry. But maybe 100 rupees or 200 rupees, not even 200, maybe 100 rupees difference will be there. Or maybe 70 or 80 rupees difference when prices are moving. So that's why approximately I am adding 100 rupees to the existing. So 1,66,492 rupees. So let me say 1,66,590 rupees. That is the way I am calculating. So divided by 1,66,590 rupees. Say around 90 rupees margin I added extra, because when prices are moving, maybe another 90 rupees, assuming another 90 rupees will go up, the margin cost. So with that value I divided, how much I got? 0.8% ROA, 0.8% negative ROA. 0.76 means round the value 0.8. In case if my trade is stopped, this is the amount I will be losing. Okay, but what is the profit now? I got 1:3, calculating 1:3 level. First of all, is there any 15 minutes target? That is also we have to look, right? I didn't look into 15 minutes target. Here we have 15 minutes zone is there, rally, base, rally. So not here. So you have already a 15-minute zone is there. So you have to book your profit here itself. But if you want to book your profit, what is the RR you are getting? 1:1.97. Let me go to 5 minutes. So if I take 1:1, that means 1:2 RR I am getting. So what I have to do? Let me take entry a little inside. I am fine tuning the entry. See, I am moving my entry until I reach 1:3 RR. Okay, 1:3 RR I am getting. So have we got the entry? Yes, we got. Prices reached this level. A little inside also it went and gave you the trade. So definitely I can consider this trade, and this is a demand zone, right? Target should be the demand zone. I gave a wrong color. See, this is our target. Our entry is not the type 2 proximal, a little inside at this level. What is the value? Entry is 5324, 10 paisa. Instead of 5322. Instead of 5322, another 10 rupees inside we took the 5324 we took the trade. Another 12 rupees inside. So luckily price reached up to that level. If price did not reach, we would have missed this trade. So this is how you will be planning. Before taking the trade, this quick analysis you have to do. See, this whole analysis, because I am explaining it, you may feel like it is taking 5 minutes or 10 minutes, because I am giving you a lot of explanation. But generally you will finish this whole thing in just less than 1 minute. How you will finish? First you go to 15-minute zone. You draw the zone, rally, base, rally. Next you go to this, you select a short position. This position will come. You add this your stop buffer value, and then you keep entry, and if up to here 1:3 is there, you will accept. Otherwise you move a little inside. So this is the entry. One more point I reduced, because now it is exactly 1:3 RR. See, more and more deep we go, there are higher chances we miss the trade. So that is the reason why we took the trade here. Now you calculate your profit. So your entry is 532405 minus, what is the profit? 530785. You got 16 rupees profit, you got 16.2. See, the performance calculations, this is how we will be doing. See, remember, this is the performance calculations. Most of the time, your trade calculations also you do the same. Before Now, okay, the trade is completed. Now we are seeing and we are drawing this. But in reality, what you do? You will identify this 15-minute zone and also you will identify this zone. The moment this candle is coming, see next 5 minutes this candle is moving. While moving up, immediately if you are observing this stock, you will complete all these calculations. You have 5 minutes time. Next candle you got the trade. Already zone is completed here. Now you know rally base drop, a 5-minute zone is created. Immediately you do the calculations. You will identify 15 minutes and you adjust this entry. You make sure 1:3 RR is there. The moment price reached here at this level, then immediately you plan, you execute your trade. See, in the next 5 minutes it reached the target and you book the profit. In 5 minutes, each share you got 16.2 rupees profit you got into 175. You got 2,835 rupees profit. 2,835 rupees profit. Okay, now you need to calculate ROI. How do you calculate ROI? 2,835 into 100 divided by. And one more point I forgot to tell you, because you fine-tuned the entry, now your risk is also reduced. Suppose if your trade is stopped out, earlier we calculated 0.8%, right? Now maybe it could have been 0.7% because of this reduced risk. I'm telling you. Okay, now what is the margin cost value? 1,66,492 because we added another 100 rupees, 1,66,590 rupees. That is what we have to calculate. So divided by 1,66,590. At the time price reaches, it could be 590 or maybe 600 also, 1,66,600, anything. Okay, anyway, 10 rupees doesn't make any difference. What is the profit ROI you got? 1:7% ROI we got. But profit is a profit, right? Okay. Did I made any mistake? Earlier stop loss. Okay, now stop loss also reduced, right? Okay. And what kind of trade we took? This is a dynamic, fine-tuned 5-minute zone this is a daily HLQ zone trade, right? So this is how I am recording what kind of trades we got. Because these comments are very important. Next time when we are looking into them, what kind of trades we get better clarity. See, the daily HLQ zone, I didn't add any comment. That means this is a fine-tuned 5-minute zone inside daily HLQ zone. If I don't comment anything, it is by default it is an assumption. It is a fine-tuned 5-minute zone trade. See, this is the 5-minute horizon trade. That is the one stopped out today. Still we have any doubt? What you do? You go to 21st March 2025 HLQ zone analysis video in the YouTube you will open and you listen HR motor what is really happening, because I am giving you this explanation. Based on this explanation, you will understand what kind of trade we got. That's it. So this is one more successful trade is added actually. See, this is not my trades, you know that. These are all performance of our HLQ zone analysis. This is what you should understand. I am not discussing my trades, I am not discussing your trades. Every day, why I am doing this analysis? Because I want to prove how our software is, HLQ zone strategy is working. That's why every day we are analyzing. My goal is to promote my software. Very simple. People should know how my software identified HLQ zones are working. But what is your goal by listening these videos? You are learning from my analysis, how I am doing this analysis. What we will be missing from your analysis, or what you might have missed from your analysis. So how to improve that gap in case if any difference is there. How to improve that area. That way you will be thinking. That way you will try, next time you don't want to make these kind of any mistakes you did. See, today even I made a mistake. What is the mistake? I missed this trade. During live market, I didn't identify this zone. Maybe I ignored because maybe there could be several reasons, but I missed it, whatever the reason. Luckily, we identified. Suppose in this discussion also, HLQ analysis discussion also, if I did not identify from our Excel sheet, one important statistical value will be missing. Maybe this zone might have helped us improving our statistics. Maybe this zone might have helped us. Of course, it helps the statistics only. Sometimes I will also see, I am also human, I will also make mistakes. But I have to admit my mistakes when I make. If I don't admit because you are listening my explanation, you will also make those mistakes. Now it is a good example for you people, how dynamic zones will be created. You already learned. Of course, some of you are already experienced people. You've been listening last 1 year. You know what is a dynamic fine-tuned zone. But those who recently completed the course and started listening HLQ zone analysis videos, for them it is a good lesson. Now they don't forget this concept. What is dynamic zone? Already you learned. In the live market zones, fine-tuned zones will be created. Maybe a new 15-minute zone will be created. Inside 5-minute zones will be created. Or already existing 15 minutes, new 5-minute zones will be created. That is what you have seen in this example. We have already existing fine-tuned 5-minute zone is there. This is fine-tuned 15 minutes, sorry. This is the fine-tuned 15 minutes. But this zone is not having a 5-minute zone. But today that 5-minute zone is created. Rally, base, rally, rally, base, rally. Next 2 candles, second candle in the next second candle, we got the trade. Not only we got the trade, again we have seen LOTL, rally, base, drop. First rally, base, drop, we got the trade. During this process, again rally, base, drop created. Next time again it may give you one more trade. Maybe this zone might be acting as a high liquidity zone. Maybe next time it might be violated. That possibility is also there. But already, those who identified this zone, they would have already got some profit. So this is a good lesson, good learning for the for the members who are newly attending HLQ zone analysis videos. Okay, this is about HR Motor. Next one is M&M, Mahindra and Mahindra. M&M Finance. M&M Finance daily, I think I didn't fine-tune this completely. Only 75 minutes and 15 minutes I fine-tuned. The daily zone we have, if drop 1, 2, 3, 4, 5, drop. Within the 75, 15 minute zone I have drawn. We have rally, 2 base candles and drop candle. Within this 15 minutes, I didn't find proper 5-minute zone. Why I'm saying? Because see, if you the same 15 minutes only you have to draw as 5-minute zone. Risk is a huge risk. It's not easy to manage the risk. And many times such kind of zones when created, some lower time frame zones will be here as an horizon. But this is not having, this time I did not find any horizon. So that's why, because when you are not comfortable with these kind of zones, see, everything structure wise looks very nice, but risk point of view very big. And moreover, 5-minute zone is exactly same as 15 minutes, is quite dangerous for the risk management point of view. So I left that. And next one is Page Industries. So this is a daily high liquidity supply zone. At the distal line, we have a fine-tuned 5-minute zone. This is a daily zone. Drop, base, drop. I think previously we already discussed this stock. This is not a newly drawn chart. And even PA Industries also the same. Previously we discussed. See, we have a drop, base, drop, having a fine-tuned 5-minute zone. Today prices did not reach. This one also I explained in the previous videos. And the Sonacom also previously we discussed this stock. Previously already we discussed, I think this fine-tuned zone is already tested once. So I think we didn't plan any trade in this zone. This is the one already we discussed. It is already a tested zone. Next one is 75-minute zones, conquer. (75 minutes) demand zone, rally, base, rally. I did not fine tune. So we didn't have proper 15-minute zone. See here, 15-minute structure is not good. Not comfortable with this structure. And the candles, no proper leg out candle also here. So I just left it. No trades planned here. Next, IRFC. This is also daily high liquidity zone. This is 75 minutes high liquidity zone. Rally, 2 base candles rally. This one is fine-tuned with 15 minutes time frame. Here we have a 15-minute zone drop, 2 base candles and a rally candle. And within this area, again fine-tuned with 5 minutes time frame. So this is the one rally, 2 base candles in a narrow range and rally candle. And this area is already tested. So that's why we didn't plan any trade from this zone. Today prices entered into the zone. But this is the area we don't have any fine-tuned zones. And the JSL we discussed, and the last one is Marico. This is also daily high liquidity supply zone. And this is also having a demand zone also, high liquidity demand zone also. This is moving in between 75 minutes, high liquidity demand and supply zones. And this one in 15 minutes we have a zone, but not fine-tuned zone is available. Go to 5 minutes time frame. 5-minute structure is not good. I'm not comfortable with this 5 minutes price structure. So that's why no trade plan here, but it is having an horizon. 5 minutes horizon, you see. Rally, base, drop, follow through candles. This 5 minutes horizon for this entire 75 minutes high liquidity zone. See the rejection earlier? Sharply prices came down, entire leg out is completed for this 75 minutes zone. But from where they picked the orders? From this horizon. So this is the area we can plan our trade. But today anyway prices did not enter into the zone. So these are the high liquidity zones identified in the previous report. Hope this information will be useful to you for your further study and analysis. Let's all meet again in our next video. Thank you.